Welcome to our channel. Today, we're diving into the fascinating and complex world of central bank policies and their profound impact on the stock market. Central banks play a crucial role in shaping economic stability and growth, and their decisions can send ripples through financial markets worldwide. From interest rate adjustments to quantitative easing measures, these policies influence investor behavior, market sentiment, and ultimately, stock prices. In this episode, we'll explore how central bank actions affect various sectors, the potential risks and rewards for investors, and what you need to know to navigate these turbulent waters. So, stay tuned as we unravel the intricate relationship between central banks and the stock market. Central banks, like the Federal Reserve, play a crucial role in the economy. These institutions are responsible for implementing monetary policy, which involves managing the supply of money and setting interest rates to achieve macroeconomic objectives, such as controlling inflation, managing employment levels, and ensuring financial stability. The decisions made by central banks can have far-reaching effects on various aspects of the economy, including the stock market, consumer spending, and business investment. Their decisions on interest rates and inflation can significantly influence stock prices. For instance, when a central bank decides to lower interest rates, it becomes cheaper for businesses and consumers to borrow money. This can lead to increased spending and investment, which often results in higher stock prices. Lower interest rates can also make bonds and other fixed-income investments less attractive, prompting investors to move their money into stocks in search of better returns. When interest rates are low, borrowing is cheaper, which can lead to higher stock prices. This is because businesses can finance expansion projects at a lower cost, leading to higher future earnings and consequently, higher stock valuations. Additionally, consumers are more likely to take out loans for big-ticket items like homes and cars, boosting sales for companies in those sectors. The overall increase in economic activity can create a positive feedback loop, further driving up stock prices. Conversely, high interest rates can make borrowing more expensive, potentially leading to lower stock prices. When the cost of borrowing rises, businesses may scale back on expansion plans, and consumers might reduce their spending. This can lead to lower corporate earnings, and in turn, lower stock prices. High interest rates can also make bonds and other fixed-income investments more attractive, causing investors to shift their money out of stocks and into these safer assets. Inflation also plays a key role. If inflation is high, central banks may raise interest rates to cool down the economy, which can negatively impact stock prices. High inflation erodes the purchasing power of money, making goods and services more expensive. To combat this, central banks might increase interest rates to reduce spending and borrowing. While this can help bring inflation under control, it can also slow down economic growth and reduce corporate profits, leading to lower stock prices. Additionally, high inflation can create uncertainty in the market, causing investors to become more risk-averse and potentially leading to increased market volatility. Central banks also use other tools to influence the economy, such as open market operations, which involve buying or selling government securities to control the money supply. By purchasing securities, central banks can inject liquidity into the financial system, encouraging lending and investment. Conversely, selling securities can help withdraw excess liquidity, tightening monetary conditions. These actions can have a direct impact on interest rates and, by extension, stock prices. The relationship between central bank policies and the stock market is complex and multifaceted. While lower interest rates generally support higher stock prices, other factors such as economic growth, corporate earnings, and investor sentiment also play crucial roles. It's important for investors to consider the broader economic context and not rely solely on central bank actions when making investment decisions. Historical events have shown that central bank policies can sometimes have unintended consequences. For example, overly aggressive interest rate cuts can lead to asset bubbles, which may eventually burst and cause significant market downturns. On the other hand, delayed or insufficient policy responses can exacerbate economic downturns and prolong periods of financial instability. Therefore, central banks must carefully balance their actions to achieve their objectives without causing undue harm to the economy. It's also worth noting that central bank policies in one country can have ripple effects across the global economy. In today's interconnected world, decisions made by major central banks like the Federal Reserve, the European Central Bank, and the Bank of Japan can influence global financial markets and economic conditions. Investors and policymakers alike must stay attuned to these developments to navigate the complexities of the global financial landscape. In conclusion, central banks play a pivotal role in shaping economic and financial conditions through their monetary policies. Their decisions on interest rates, inflation, and other economic variables can have profound impacts on stock prices and overall market dynamics. Understanding the mechanisms and implications of central bank actions is essential for investors, businesses, and policymakers to make informed decisions and effectively manage economic risks. If you found this video helpful, we encourage you to take a moment to show your support. Your engagement helps us create more content that you love. Make sure to subscribe to our channel by clicking the subscribe button below. This way, you won't miss any of our future updates and valuable insights. We regularly post videos that delve deep into the intricacies of the stock market, providing you with the latest trends, analysis, and expert opinions. Our goal is to help you make informed decisions and stay ahead in the ever-changing world of finance. Whether you're a seasoned investor or just starting out, our content is designed to cater to all levels of expertise. Thank you for watching. We appreciate your support and look forward to bringing you more valuable content. Stay tuned and happy investing.